Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. Thank you for watching our third quarter 2020 review. Let's get started, shall we? So early in the quarter, we saw reopening move forward at a great pace. The virus migrated south in some of the states during the quarter, and some of these states were the ones that were largely spared from the first wave that happened during the second quarter. So the Southwest and Florida, we saw some spikes in cases there. Overall, meanwhile in Canada, I should say, most provinces and the hardest hit areas progressed through the opening protocol. Jobs came back. It's safe to say that we're about 50% of where we were during the depths of the crisis in terms of unemployment, where we saw sub 20% earlier this year. Now we're still in double digits, but we're about halfway through. We still have some industries that are still looking at more cuts, largely the industries that are most affected by the pandemic. So think entertainment, restaurants, and travel. Largely those are the businesses, and some retail. Those four industries really have been hardest hit by the pandemic. Really, it's any business that has a close contact with their customers or that relies on foot traffic to attract customers. However, what the headlines are leaving out, there are some sectors that are ramping up. Try buying a dishwasher these days. Try getting a house built or buying a house. So there's really been a chasm created by this pandemic. That's really created what we call the K-shaped recovery. Some have and some have not. So retailers that built out were able to pivot. Online did very well. That's not only true of retailers, but other businesses at large. So for instance, Target reported a growth on their web sales of over 195% for the period ending in August. So, however, if you're a retiree and can provide the same level of productivity away from the office, your financial life didn't really change that much. In fact, you're probably ahead. Your budget around travel, restaurant, entertainment have effectively been slashed to zero. This would explain the continued and unprecedented results in some sectors like leisure, local travel, home improvement, and things like boats, motorcycles, RVs. Try getting a barbecue, and a lot of tools you'll find are actually back ordered. So those are the top leg of the K. But if your job depends on foot traffic, you're effectively toast. Mall operators, travel, downtown coffee shops, restaurants, without takeout, men's suits, cabs, forget about it. They all been crushed. So really, that's really what we're focusing on. Technology is leading the way. Whether you're providing technology or benefiting from it by leveraging it, as I said in our example with Target. New trends: technology, work from home, sneakers at the office. Now, even if you do show up, closing sales on Zooms, drinks on Microsoft Teams. Those are all new things. Drinks after work, that's not happening. Lunch with the clients, again, not happening. So this pandemic really has accelerated certain trends and created new ones. Some trends are gone for good, while others will slowly come back. I'm old enough to remember when the terrible events of 9/11 happened. People swore off traveling. It took 4 or 5 years, but pre-COVID levels, travel was significantly up for where it were 10 or 15 years ago. So the travel levels in 2010 and 2019, about significantly below or above 2010 levels. So we feel that brands and locations are the best counter to a lot of what's going on right now. Companies can maintain a connection with their clients through the web, but have really good locations. Think of Starbucks. Their suburban business is going gangbusters, or McDonald's. Yes, they're having trouble with their downtown locations, but they're well spread out, and the name still remains something to be reckoned with. So here we have, as an example, boat registration. Spiked nearly 32% in 2020. In fact, some dealers are out of products completely. And we'll contrast that with something else. When we contrast it to the foot traffic or the number of riders in the subway system in Manhattan, we were running at 4 to 5 million travelers a day pre-COVID, went all the way down, basically went down 95%, and now we're about we're still down 60% or more from a foot traffic. So really, you can contrast that. This is really the two illustrations of the K. Businesses relying on travelers, terrible business to be in. But if you're relying on excess capital being spent somewhere, the leisure trade is the place to be. So let's look at the performance. At the end of the day, technology ruled the day. The NASDAQ killed it. The S&P 500 as well did very well. These are technology-heavy indices. The TSX, our Canadian index, a lot lighter on the technology front. So is Europe. So really, at the end of the day, if you didn't have a lot of technology, you probably are still down 10 to 20% from pre-COVID highs. Our average portfolio tends to be down around 10% from pre-COVID highs. Some portfolios that have a heavier technology weighting will have done better. The oil price is still down. We're around $40. We were $65 plus pre-COVID. The VIX, still an issue. The investors are still expecting a large volatility in the next 30 days. We're down from the past quarter, but we're still up significantly from the beginning of the year. The other important note, low interest rates. We have to go back to 1940 to find basically 0.5% in terms of yields, both in Canada and the US. So we're still constructive on the equity markets, partly because of that. There's simply no alternatives to stocks. You can't really buy bonds and lock in 0.5% for 10 years and make your retirement plans. So really, we're going to have to expand and accept that there's going to be some volatility, but you can still buy a good Canadian bank stocks, European conglomerates, Chinese wireless telecom companies that are being sold for single-digit PEs, so low valuation, and you still get 4, 5, 6% dividend yields for your trouble. So that's why we're still constructive on the markets. There's still a lot of opportunity left. There isn't a performance anomaly that I want to delve into. We talked about technology and how it drove performance. So here's logically, or I say an illustration of the S&P 500, and here are the 5 largest companies in the S&P 500. They make up almost 5 or over 25%. And their performance has been great. Apple's up 57% for the year, Microsoft 33%, Amazon over 70%, so is Facebook and Google. They're all up huge. But it's interesting to see if you're not there or you don't have as much technology weighting as the index, which is what's going on with here at Exponent. We do have some technology, simply not as much. We don't have 25% of anyone's portfolio in technology. So the top 5 stocks, those 5 stocks alone, year to date, they're up almost 32%. But the bottom 495 stocks on the index are only up 2.5%. So this large differential, it actually is coming down, but it was significant back in August. It's rare. It's rare that it lasts this long, and it's pretty rare that it's this wide. So that's why we call it an anomaly. So let's look at the economic snapshot, if you will. I'm not going to look at numbers, but we're just going to look at a different view. Let's look at it from a pessimistic versus more constructive or optimistic way. So really, in finance, many associate conservatism and as being more prudent, and conversely, being optimistic as being more naive, uneducated, even sometimes reckless. It's interesting to note, though, that markets, days if you count the number of days that where the market is up versus down, 54% of the time the market is up. So what we've laid out for you here is sort of the pessimistic view and the counters optimistically. So if you're really worried, if investors are worried about virus cases, absolutely it's an issue. But the mortality rate is much lower. Elections, always contentious. But it's not the first time that these contentious elections happen. The national debt, always an issue. In fact, it's a global issue. But the cost of this debt is really historic. You got to go back again to the 1940s, another high level or high indebted period for the world. Interest rates were very low. So the cost of carrying this debt for governments is quite low. The chasms, the socioeconomic chasms, they've always been with us. I mean, the Marshall Plan effectively rebuilt Europe that was in tatters. The Cold War ended. China in the 50s was basically backwater, and now it's the growth is unprecedented. It's a world power. So I always think back to the lyrics from Billy Joel, Didn't Start the Fire, to go back and sort of give you some historical context. We are in unprecedented times, but not really. We've had polio before. We've had other pandemics, the H3N2 of 68 and 69, the HIV pandemic that's going on as we speak. These viruses are part of humanity. How we deal with them might have changed to what we've done in the past, but they've always been with us and will continue to be with us. So let's look at our valuation snapshot. I'm going to focus on three numbers, really. The earnings, they're going up. That's good, both in Canada and in the US. We're certainly not expecting the same type of earnings we did pre-COVID, but that's really what to expect. So it really goes back to our, 10 to 20% economy. Canada is still nowhere near expensive, but the US is very expensive. It is, in fact, it made a new high. Really, why is that? Well, if you stop and think about it, if the S&P 500 is becoming more and more of a tech-heavy index, we know that technology companies tend to support a higher a higher PE ratio. The other thing that's important is that technology companies, when they have lower interest rates, a lot of companies will have future growth. So that future growth translates into a higher present value with low interest rates. In other words, the lower the interest rates go, the more it benefits technology companies. If you compare that to a slower growing company that might pay a dividend, where the return for the investor is less weighted towards the future. So the winners and the losers. I don't want to be a dead horse here, but I guess I will. I don't want you to think that we've got an aversion to technology either. Quite to the contrary. But as a rule, we prefer to invest companies that leverage technology versus the ones that provide the actual technology. Sometimes we also like to buy the companies that provide key components. So a great example would be we will have more electric cars on the road, but rather than picking the next winner of the electric car race, we'd rather focus on the companies that might provide software or hardware that goes into the industry at large. The power of the web. This is why the nature of solving problems is critical to any investment decisions. They've driven a lot of a recent investment success. So if companies aren't leveraging the web, they're really not really having it. If they're solving problems, people will pay up for them. Now, the exciting narrative is a bit of a problem for us because it's a double-edged sword. On some level, some of the companies that we've picked are really, really cheap, but the narrative is also very, very negative. Think oil and gas or real estate. And we can contrast that with the valuation of Tesla. And that exceeds the market value of most of the world's car companies combined. However, the narrative around Tesla has really changed of late. The bulls tell us to not think of Tesla as a car company, rather as a power company. That's right. Tesla bulls are telling us that Tesla is really about managing power, how to produce it, how to store it, and how to sort of use software and hardware to manage it. In effect, they want to take on, the power generators like the public utilities. They want to make the public utilities defunct. That's a tall order. I have no idea if that's technically feasible, but that is the current narrative around Tesla. So I'm simply pointing out that the investor's narrative can move a stock well past its fundamentals and bake in a tremendous amount of future success. Remember, Tesla is still cash flow negative, and when you back out, it's cash flow negative when you back out the government subsidies. So the narrative and the investors' public buying into the narrative is what's critical for Tesla to continue to move up. On the bottom end, it's the reverse. The industries that were affected by the pandemic, and the narrative is that they'll never come back. People will never travel, never go back to the movies or go to Disneyland or Disney World, and never go step into a retail store ever again. Those absolute statements are really, really dangerous. And for us, sometimes they can offer some upside because some stocks and some sectors really get discounted well past what makes sense. If your business 100% depends on old school and you haven't pivoted it on leveraging technology, you are in trouble. There is no denying that. If you're selling suits, you've got issues. If you're selling suits in a mall, you've got a lot of issues. And if you're selling suits in a mall that's downtown, you're probably in a world of hurt. So sometimes the narrative, your stocks might offer some great potential, but they're not part of the new narrative. Oil and gas, as I mentioned. So I'm not sure I would run out and buy, a retailer that's mall-based downtown that's selling formal clothes, but some sectors we do believe will come back, and we are taking advantage of the low valuations. Example of it is that downtowns versus suburbs. Those are new trends that we're working with. A great example of that would be Starbucks. I mean, it's doing great in the suburbs and not so well downtown. But as people come back, the coffee habit will continue. McDonald's would be a similar story. As people travel more, continue to, as they take the car more, that traffic will come back, even though the suburban stores are doing quite well right now. In fact, the fact that they have drive-thrus is really making McDonald's provide some very good results despite being in the middle of a pandemic. Let me leave you with some parting thoughts. We're all either left brain or right brain, so what I've laid out here is sort of a right brain, left brain type of conversation. As a portfolio manager, our job is to really work the left side, if you will, of this presentation. We look at research, sources, look at valuations. We're looking at real live observations about the businesses and the industries that we might be investing. We do some financial planning work, some communications amongst each other to try to come up with some good investment ideas. We look at what's baked in or not and valuations. We go back in history. We all have tremendous experience as portfolio manager, and so we delve into those experiences to give us a sort of framework to build these portfolios, the knowledge and the communication with our external partners, if you will. Opportunities, we see lots of opportunities. We're actually quite constructive on the markets, but sometimes we might be early versus wrong. So, but as a client, we know that it's really the right-hand side that's going on. So emotions, headlines, many of you read a lot, talk to friends and family, so capture the narrative. And sometimes the portfolio doesn't always capture that narrative or the crowds or what's going on in your social circles. Performance, let's face it, we all compare performance. So when your performance doesn't match either what your expectations are, maybe we're lagging a little bit versus a particular benchmark. We've done this before, but we are cognizant it does create anxiety. A lot of people will call us and call upon us to talk about the new normal in the future, and very often we're not as enthusiastic from an investment perspective. It doesn't mean that it won't happen. It just means that it's very difficult to get some positive operational or performance out of it. The whole idea of this is new. We run portfolios. We've been running portfolios for 20 years plus for most of us as portfolio managers. So we've seen a lot of these quote unquote unprecedented times. As a client, it is probably your first time. So it leads to a lot of anxiety and around the volatility and even some of the losses that we've created. So the parting thoughts is it's normal to have sort of left brain, right brain type of situation, but our job is to help you walk you through it, because undeniably, we're going to have to walk through some rough patches in order to get the long-term appreciation that stocks offer. So as you're going through your readings and your chats and just going about your life, remember that incentives trump ethics every time. So research providers, news outlets, websites, YouTube channels, industries all have an agenda. So it's important to understand the agenda in order to understand the data. There's no doubt that the current economic climate is under duress. That's why we see opportunity. Governments and central banks have taken steps to counter the fallout of the pandemic on the economy. And we see some pre-existing trends that we talked about earlier. Some beneficial and some others have much more dire consequences. But they have accelerated this pandemic, which is good for us as we were looking for opportunities. So let's talk about strategy. So we obviously need to keep an open mind. We want to remain flexible and pivot into opportunities and away from threats. We want to assess the potential outcomes. I'll get through that in a little bit. We want to make some portfolio adjustments. Remember, some of the indices that we're competing against have much larger weights into sectors, both in terms of names and in terms of exposure to industries. And we want to share with you, so how do we deal with low probability events, but that will have a high impact. You need to respect those. So if we start by going through a bit of our exercise, we want to remain flexible. So we're working with three possible outcomes. So the first one would be a low probability event for sure, which would be a healthcare solution within 6 months. So that could be a virus, but it also could be a protocol, a treatment protocol, therapeutics we call them. Those would have a great outcome for investors. The more probable outcome is something like 18 to 24 months to go in this sort of clumsy reopening, slow economic climate, some winners and some industries or economic agents that are simply being left behind. And there's still a lot of spare capacity in the economy. That is probably the more probable outcome that we're working with right now. So as we build the portfolios, we have some exposure to a quick reopening. We have more exposure to this 18 to 24 month sort of clumsy future, short-term future, where consumer brands, financial names, those are really the names that will do well. Whereas in the first, in a short reopening or in a short-term reopening, pharmaceuticals, oil and gas, or even real estate will do well. So you want to have exposure to all industries. And finally, you want to remain open to a more pessimistic outcome, like a 3-year subdued activity level. So that's why you would have utilities, gold, consumer staples for this possible outcomes. Obviously, those sectors won't do well if we have a quick reopening or we have sort of a still somewhat moving forward economy. So also we have cash, because you need to have some function of a healthy respect for upcoming political elections and short-term reactions to those investors. So you want to be able to steer in and out of those short-term situations. Thank you very much for watching. That concludes our video or our review of the quarter, what transpired and how we're moving forward with the current climate. Thank you very much for watching. I'm Benoit Poliquin from Exponent Investment Management. For those of you that want to go into more in depth and get to know what we're looking at, so as we say, get into the weeds, stay tuned. So let's get started with the supporting charts. One thing that we're looking at here is where is the money going from investors' perspective? First thing we're going to look at here is the money flow. So on the US side, the flow is negative in terms of the broad index, but it's much more positive in terms of the more technology-laced indices like the QQQ. So there's still a lot of negative money leaving certain sectors. In Canada, it's much more broad-based and the dollars are all positive, which is interesting. This is more of a normal situation where you're having pockets of capital being attracted and money leaving certain sectors. It's pretty rare that you see green all the way through. So that's an important piece to continue watching. I'm quickly going to go through the returns. We've gone through this ad nauseum, but I just want to show you the charts all pretty much look the same. We've got the S&P, the IEV, which is Europe. We've got the emerging markets. All the sectors more or less look the same, which is very fascinating. And so correlation has really gone to one as, I think, as central banks and the different government agencies have really reacted in the same way. Some sectors are higher pre-COVID, and some sectors like the TSX are not. So it's interesting to watch. The VIX, we had this historic spike, and now we're still in elevated. But remember, those are the past 3 years, if you will, and it's quite normal to have sort of these spikes anywhere between 40 and 15. So we just had a period of time here, pre-2018, if you will, 2019, I should say, where we didn't have any volatility. In one of our previous videos, we went over why that was. Oil and gas, we obviously, and gold, all sort of similar, sort of flatline type of pricing. The bonds. Well, the Canadian bond market, the white line here is the close of the levels. We have to go back to the 1940s to see these low interest rates. And same thing for the corporations. So what's interesting here, both in Canada and in the US, is that when we're looking at companies, whereas we tend to shy away from companies that have high debt levels, we still have that sort of preference, if you will, but sometimes some companies in some industries will benefit from these low interest rates. So you can think of highly levered industries like telecom or real estate or even oil and gas. So as these low interest rates stay with us for a long period of time, not only does it make stocks more attractive, but some sectors will benefit as their debt rolls off and gets refinanced, if you will, at significantly lower rates. That will make those earnings, the earnings of those companies, go up substantially. Stars and dogs. So clearly in Canada, the dog part is oil and gas, nothing but. And what's done well is pharmaceuticals, but also it's sort of a mixed bag here. So some retail names. A lot of these good performances are actually bounced back from terrible performances in the second quarter. So there's not a lot to read into this table in terms of the best performing stocks. If we go over to the US, it's interesting. So you had FedEx and UPS, which had outstanding performance in the third quarter, and these were unloved stocks at just a quarter ago. We see Whirlpool, so obviously the trade on home improvement, Mosaic, which is fertilizer stock. So it's sort of a mixed bag, but it's very interesting. There's some bounce backs from terrible performance in the second quarter, and other continued performance, so like advanced micro devices. So on the worst performing front, you had First Energy, so basically all energy names, just like Canada. This sector has just been decimated. Some of the headlines. So Nolan was good enough to find some old headlines, so we went back to what's driving. So the NHL, everyone expected the bubbles not to work, but actually they did work. Everyone's talking about a vaccine, polio. They did come out with a vaccine, but it was a clumsy it was a clumsy effort. It took a while. And so even if we do have a vaccine, we're not out of the woods yet. Robinhood, so the advance of the do-it-yourself investor is something that we're watching. Disney laying off a lot of people. At the same time, you're seeing sort of existing home sales going through the roof, and we're having good employment numbers. So it's sort of a mixed bag here, what's going on, depending on if you're what sector you're focusing on. I'll leave you with these two interesting charts. So we're looking at what are called shorter term data points. So we're looking at miles driven, and we're still down substantially, but we're still back to 2010 and 20 sort of early in the past decade. So while the headline is dire, the economy is still turning over. The other is a housing start. So we're seeing we didn't see any housing start during the pandemic. So is the pricing of new homes really a function of that much more demand, or simply an out of kilter situation where you had sort of pre-existing demand for new homes meeting substantially less supply because of COVID, or even some studies are showing that some of the immigration policies in the U.S. are having an effect on less housing starts, or maybe the wrong housing starts. So that bears to be seen what we're looking at. Thank you very much for watching. I'm Benoit Poliquin from Exponent Investment Management. If you have any questions or comments, please drop us a line at the address below or on the screen.